So we'll talk a little bit about taxation of entities. You guys are getting into these new entities. I hope I don't double up on much. I don't know what you're talking about, entity structure or anything, but we'll see if you get some of this twice or not. So you got your different types of entities, and it's good to be aware of those. We're going to focus mainly on the LLCs. That's what the B-Launch program uses. All the entities that have been formed have been LLCs. And so we'll mainly focus on that, but we'll touch on some of these others real quick just to give you an idea of what's there. So corporations, those are kind of the big ones that I think a lot of people think about when you think of publicly traded companies, buying stock on the stock market. You're thinking of C corporations. You have shareholders. You can also have smaller ones. There's a lot of smaller corporations as well that we deal with. So it's not all just the big boys in that category, but I think that's one we think of when we think of companies. S corporation then, similar to a C corp. It's formed the same. You have corporate documents, but you have generally fewer shareholders. There's limits on who can be a shareholder, and you have to make an election to be taxed as an S corporation. Partnerships, all sorts of different types of partnerships, limited partnerships, general partnerships, limited liability partnerships. All those will be taxed similarly on a partnership tax return. LLC is an interesting one because it's very versatile. If you have one member, it's what the IRS likes to call a disregarded entity. And while it stands as its own legal entity, the IRS just looks right through it and says, who owns this? That's where this is going to be reported. So if it's an individual that owns it, it just gets reported on the individual's tax return. If it's owned wholly by another partnership, it's just kind of sucked into that partnership as well. If it has two or more members, you'll see that it's defaulted to be taxed as a partnership. I'll file a 1065 partnership tax return, and everything will look pretty similar to the partnership filings. LLCs have the option to, they call it the check the box election. You can file a form, check a box, and say, I want to be taxed as a corporation. And it's just that easy, and the LLC can be taxed as a corporation. It can also be taxed as an S corporation. So I think that's one reason that we form these LLCs, is that it gives us the base for the B-Launch program to start as an LLC. Down the road, we have some flexibility of, if things change, do we want to do something different with it? And we can. I guess one terminology difference, you'll see corporations, we're going to refer to the owners there as shareholders. They're going to own stock. Partnerships, going to be partners. And LLCs are members. So if you hear those different terms, kind of interchangeable, but each apply to the different type of entity. So I guess going back, a C corporation is the only one of those that is taxed at the entity level, meaning so when it files its tax return, it pays tax at that level, and the income is accumulated, the deductions accumulate, everything at that level, and you either have a taxable income, taxable loss, and you pay tax at the entity level. The shareholders don't have a taxable event until that company distributes money out and you have dividends, right? So you've seen maybe on brokerage statements and stuff, companies pay out dividends, and you'll be paying tax on that. The rest of these, S Corp, partnership, and these LLCs, as we're going to talk to them, either taxed as an S Corp or a partnership. The B-Launch ones are all taxed as partnerships. Are what we call a flow-through entity. And so what that means is all the income, all the deductions, all the credits, everything's kind of compiled on the partnership tax return or the S Corp tax return, and then it's passed through to the owners on what is called a Schedule K-1. You can kind of think of that as like a W-2, and it reports to you your share of the income, your share of the credits, etc. So we have all these different buckets of income. If you think about it, ordinary business income is going to be taxed differently than dividends or capital gains or whatnot. And so what those returns really serve to do is kind of summarize the activity of the entity. And that's what's then going to get passed through. And as owners, you'll need to know that you're going to need to wait for that K-1. You're going to need to know, do I have income or loss or credits? What do I need to be picking up from the business that's going to be coming to me? Especially if you've never had business ownership before. I think a lot of times we get people who jump into filing their tax return that first year that they've been in the business and don't realize that they need to wait for their reporting from the partnership. So this is just kind of a summary of what I just talked about with you basically got all your different buckets: ordinary business income, rental income, interest, dividends, royalties. All those things have different tax consequences, subject to different limitations, things like that. That's all summarized on the return, and that's what will be passed out to you on your K1. And a little bit easier to understand probably once you get in the business and you see what kind of income you have, what kind of deductions you have. You'll be able to follow that through the return as well. But just to give you an idea of what you could be looking at. Limitations. There's several different limitations, especially for startups. This comes into play. A lot of times, startups aren't going to be profitable those first year or two, or they've got to get their feet on the ground. They're working on generating the ideas, generating the profits, and it doesn't always come at first. So it's probably going to kick off some losses at first, and the question becomes: are those losses deductible to you? Can you use them, basically? Will it reduce your taxable income? And that comes down to, you got 3 limitations to look at. The first, and probably the biggest, is a basis limitation. I like to call it the pay to play. Did you put some money into this? Basis is formed from money you put in plus any profits minus anything you've taken out through the way of distributions, etc. So do you have the basis available to deduct a loss? And I guess as an example, these B-launched entities, we have the angel fund contributing the initial capital, and we have the members in their separate company that have not put anything in. They bring in the ideas, they're bringing the boots on the ground, basically. And so those first years of losses generally aren't deductible to the members because they haven't put anything in yet, and we haven't generated profits to raise basis. So the angel fund may get some deductible losses because they've basically paid in, they have the basis. The at-risk rules, those are a lot more complicated. Do you bear the economic risk of the loss? There's a lot more to that. We won't really dive into that other than to let you know that it's there. And the passive activity losses, if you have passive activity, if you have investment activity, rental activity, things like that, you have to have other passive income to offset those. That's generally not an issue with the B-Launch program entities because you guys are actually actively running these businesses. It's not passive income, but one more limitation to watch for. So one last thing to always think of too is self-employment tax. We're familiar with income tax. Everybody kind of thinks of that part when they're making income. The self-employment tax is kind of off the radar a lot of times until you file that first tax return, and you get hit with an extra tax bill if you have some profits from self-employment income. And the way to think of self-employment income is when I go to work, I get paid my wage, I get my W-2, and it has withholdings from it for FICA taxes, Social Security, and Medicare. Now, I've paid half of that, and my company has paid half of that. Now, as a self-employed individual working for a company that you own like this, you're going to be basically wearing both of those hats. You're going to be in the company working as an employee, but you're also going to be the owner of the company. And so that income, it's not going to flow through a W-2. You're not going to get a wage. You're going to basically have, like I said, that K-1, and it's going to report to you self-employment income. And so when you file your tax return, you'll see that not only do you have income tax being calculated, alongside that you'll have a calculation for self-employment tax, which is basically you're going to be on the hook for both the employee and the employer portion because you're wearing both of those hats. There's also a deduction you'll see flow through the first page of your return for half of that, which is kind of levels out the playing field for the employer. When I get paid my paycheck, the employer is deducting their half as a deductible business expense. So you'll see something similar flow through for that half on your return as well. So one more thing to remember with that is that you don't have withholdings. You don't have federal income tax withholdings for your income from these K-1s. So it's important to do proper planning, think ahead, monitor if you're going to have profits. Do we need to be setting aside some money to distribute to pay taxes, things like that. And to avoid penalty, you generally have to make quarterly estimated payments unless you meet certain exceptions. But even then you need to properly plan to have that money available at the end of the year to pay those taxes. A lot of times you'll see partnerships get to the end of the year and they'll make a distribution to pay taxes on any income that they are kicking out to their members. So with that, I'm going to turn it over to Travis. He's going to talk to you about financial statements, some of the most common ones and why they're important and who's going to be using them.
All right. This is where we start getting into more of the numbers. I mean, he talked about the income tax reporting and how that's going to affect you personally. Now we'll just get a little bit into the really exciting accounting stuff. I know that everyone, when their little child wants to grow up and be an accountant, and this is the kind of stuff that's exciting, a little bit more exciting than being a policeman or a fireman or an astronaut. So this is the stuff that I know you're dying to hear. The three most common statements, and these are talking about financial statements. You have your income statement, your balance sheet, and your statement of cash flows. Sometimes they're called something else. Sometimes they're called P&L. You'll see that term thrown around. It's just profit and loss, same thing as income statement. A balance sheet's going to have your assets and liabilities, and then statement of cash flow statements. There are several different formats. I won't bore you with this, but the most common when you're starting out and someone just wants to just informally get a copy of your financial statements, an investor or a lender or anything like that, you're really going to just prepare it in-house, and you're going to kind of do something that may be more typical for your type of industry. If it's high tech, if you're doing, say if you're creating an app, or if you're making a product, food, whatever the piece may be, you might have a little bit different format. But once you get into having audited financial statements or reviewed financials, then it falls into this procedure called generally accepted accounting principles. So these are standards that have been set across the country. Internationally, they have a little bit different set of standards, but they understand the US GAAP is what we call it. And so it's something that people really understand, and they expect it to be the same. That way apples can be compared to apples. So when you're looking at two companies, you can really compare how they are performing and what their financial statements are telling you. What do I have on here? Income statement, pretty self-explanatory. It measures your profitability over a period of time, usually a month, quarter, or a year. Those are usually the most common type of periods. Don't confuse it with cash. Most of the time, it'll be on accrual basis, because accrual-based financial statements give the best picture of what really is happening to that company. And so you don't want to confuse it with cash. Just because you have $50,000 profit doesn't mean that you have $50,000 of cash in the company, and vice versa. Just because you have a $50,000 loss doesn't mean that you're negative $50,000 cash. Of course, your income, expenses, other items like generally your income and your expenses are your core business, whatever that trade or business is. So if you have any extraordinary items, interest income or anything like that, you'll kind of put it in this other category. Something that's not because of your core business, you'll kind of put it into that other category. And this is what just kind of a basic example. You can see you have your gross revenue. Sometimes it'll be gross sales, depending on the standard. If you're making some kind of product, it'll be cost of goods sold. It could be cost of services. What are some other terms that they have there? But this is kind of taking a look at manufacturing, because this is where you have materials, supplies, packing, and then you're going to have your gross profit. So that's going to be your real core business. It's going to be what you're selling and the revenue you're bringing in for your product and what that product costs. And then down below is kind of your operating, your overhead is a term thrown around, your sales, your general sales and operating expenses that are flowing down here. So something that's not key to your core product that you'll kind of split out. And that's usually like the accountants, the attorneys, advertising, things like that. Things that you don't necessarily have to do to make the product, just things that have to be done for the business to operate. And then this is where I kind of mentioned the other items: interest income, interest expense, tax expense. You could have depreciation up in the operating expense. Sometimes it might be down in the other expense, but generally up in the operating expense. Balance sheet. It's a snapshot of a financial position given at a point in time. Remember, income statement called it covered a period of time, so it'd be January 1st through December 31st. So you're looking at 365 days, 1 year, 1 quarter. Balance sheet is like taking a camera and you're taking a snapshot of your business. So you're coming in here, say this is your business, all these tables and all these chairs are your assets, everything in here. So a balance sheet is you're taking a picture of that business right there and you're saying, okay, what assets do we have at that day? What liabilities do we have on that day? What was our cash balance? You know, it's just like a point in time that's frozen. So your assets are what you have and what you own. Liabilities are what you owe to others. And then equity is whatever's left over. A lot of times you may, especially not typically in the founding members, but it does happen in founding members, but a lot of times when you take on a new partner or member into your business, there's confusion between are they giving you a loan or are they giving you equity? And so that's kind of the difference you have to make there. And typically liabilities, if you go bankrupt, you may not have to pay them back. Or liabilities, you have some security, may not have to pay them back. Equity is who gets paid last. So if you go bankrupt, pay off the debts, whatever the agreements are, so the debt is paid off first, ranked based on security. You know, someone might have a really secure loan, so they may be first in line, and it gets down the line, and then equity are the owners, they get whatever's left over, which is typically in a bankrupt situation, of course, is zero. The financial statement, it balances. That's why it's called a balance sheet. So your assets minus your liabilities equals equity. Or you can look at it and say assets equal liability, or assets equal liabilities minus equity. So it balances. The two sides, assets minus liabilities, are going to be the exact same number as your equity. Here's a typical example. This one is, I wanted to make it a little bit more realistic of as you're starting up with your companies, because in year one, you're really not going to have anything. I mean, your balance sheet is zero. 0 minus 0 equals 0. Or you put in $1,000 cash. So you go to the bank, open up a bank account. You have 4 owners. You all grab $250, go put it in a bank account. So now you have $1,000 cash, and that's your equity. You each have $250 equity. And then as the business goes on, and then you have operations in 2013, you end up growing your cash, you build up your inventory, you have some receivables out there, customers owe you some money, property, plant, equipment. Now you've bought equipment and you're operating it and you're making products. And when you buy equipment, you have to kind of remember if it's something that lasts more than 1 year, 1 period, that typically is what they call capitalized, so it becomes an asset. But it's depreciated over time. You don't just buy it for $50,000 and it's a $50,000 asset for 5 years. That has a value and a use that's going to depreciate over time, just like you always hear about your personal autos. And so you're taking depreciation expense each year. You're going to have accounts payable because you're going to buy things on terms. And so remember, at a snapshot at that point, most likely you don't have everyone paid up. So it's like, okay, who do we owe money to? You're going to have accrued expenses if people are working for you and they're, you know, say you pay them every 2 weeks. So at the end of 1 week, you're going to have these accrued expenses that you're going to have to accrue and show that liability, because eventually you're going to have to pay them their wages. You're going to have to pay payroll taxes on their wages. Income taxes payable. If you're a C Corp, you're going to have income taxes payable. S corporations and LLCs typically won't have that. Of course, startups still usually have credit card debts and a lot of liability. So this one, you know, assets minus liabilities equal equity. So you have 185 minus 180 equals your 5,000. You know, this is typical. You see a lot more balance, or lot more balance on the asset minus liabilities equals equity. So you see a lot less equity until the company really starts growing. To build up your equity, I mean, that means you're showing profit each year, and it's accumulating that profit. In year one, if you make $1,000, then your equity, say in this example, you made $4,000, now your equity is $5,000. Next year, if you made another $5,000, now your equity is $10,000. It has this term called retained earnings, so that's just kind of a scorecard of what you've accumulated over time. Statement of cash flows, I mean, this is pretty obvious, just like it says. Where does the cash come from? Where does cash go? Think of it as a change in balance sheet. So if you had a $1,000 beginning balance sheet, or we'll just say $0 on day one, and you took the $250 from your 4 partners and put it in the cash account, now that's $1,000 of cash flow that just came into the business. And then it's also accounting for where it goes. So if the next day you wrote a check for $1,000 to your attorney for setting up the organization, now you have an expense for $1,000, and that's going to show in your statement of cash flows. There are 3 different types, just like any other financial statements. There's differences. I won't get into the detail on these. Just know that there are 3 types out there. So if someone's looking for a statement of cash flow, you may want to ask the lender or the person you're looking to seek some, say, angel funds or something like that. Well, what kind of statement of cash flow are you looking for? So here's the typical example, starting cash. So remember in 2012, we put in the $1,000. 2013, we had the operations. So anything that is a non-cash item over here, like depreciation, that's a non-cash item. We did put $50,000 of cash, or we had a loan of $50,000 to buy it. But as we're depreciating it, that's a non-cash item. Accrued expense, that's a non-cash item. Those are expenses that you're going to have to pay next week or next month or something like that. So all you did is record the expense and record the liability that you're going to do it, that you owe. So nothing happened to cash with that adjustment there. So if we go back to here, so it's looking through starting cash, where'd the receipts come from, collection of sales, interest incomes from funds from lending. Accounts receivable is another thing. So your sales are reported in your accounts receivable. So if I sold something to you for $10,000, I'm going to have a $10,000 account receivable and $10,000 of income, but I don't have any cash until I collect it from him. If I have it on terms, 30 days. Right now I have an AR, so my statement of cash flow in that example would be 0 because nothing happened to my cash. And 30 days later, when he paid me that $30,000, now my accounts receivable goes to 0, and I put $30,000 in the bank. The income doesn't change by the fact that he gave me the cash because I've already reported the income when I record this receivable. So then my statement of cash flow would show the $25,000 incoming on the receivable. And then of course actual cash expenses that you're paying out during the period.
I'm a big Dilbert fan, and I found this one pretty funny when we found out we were going to talk about budgets. He says, at long last, I finalized the budget, and Dilbert just kind of looks at it and says, this is the budget for last year. And he says, stop making it sound so annual. And I think that's the mindset that a lot of people get into. And it's one of the things I guess we'd like to stress today. It's something that should be done up front, and it's also something that is a cycle. It's something that's going to be continually done over time. You can't just do it once and set it aside and say, yeah, I've done my budget. So I'm going to talk about budgeting. Travis is going to talk some about forecasting. And then the rest of the cycle is, like I said earlier, putting the boots on the ground, implementing it, and then stepping back and analyzing kind of real time, how are things going? What adjustments do we need to make? It's just a continuous process. There's always room for improvement. Who here has an experience with budgeting? Does anybody do a personal budget? Yeah, so we've seen some. We know what we're talking about here. What are some reasons we budget? Anybody got ideas? Why would we do this?
Telling money where to go.
Yeah. Yep. It's exactly right. So one thing, especially for startups too, is it can play into as you're looking at all your different ideas, is it feasible? Is this really going to be something that can be profitable given the resources that we have and what we're looking at? So we kind of need to run budgets as we're even doing those initial startup phases, as we're looking at ideas and figuring out what direction we want the company to go. Financing, whether you're going to be going to a bank or going to an angel fund and presenting, I guarantee you're going to step up in front of them. They're going to want to know, how are you going to use my money? How are you going to get a return? And what's your plan there? A budget is a great way to present that and show them exactly, that you've put the thought in of all these different considerations that are going to impact you financially, and not just focus on the idea itself, because everything has to be funded too. Real-time analysis and management decision-making, those two kind of come back to the internal, to you guys, as you're going throughout the year, as you're going month to month, or as you're getting your businesses set up. Are we spending too much in one area? Is there some place we can cut back? Can we switch a vendor and save some money here? Those kind of decisions can be made if you're monitoring your budget and you're seeing, well, are we spending too much on this, or are we, can we redirect and refocus some of our funds somewhere else where we get a better return? And if you're not monitoring that stuff throughout the year, you might get blindsided by something you didn't even know was there. You might be spending too much someplace you shouldn't be. So basic components, you're obviously going to have your revenues and sales. I also like to include in that your financing, especially for startups, because at first you're not going to have sales. Your initial, what you're going to bring in is your financing. It's going to be your investors. It's going to be a lot of startups do through bank loans. And you're going to need to know that that's basically your cash flow coming in, and you need to figure out how am I going to budget that to make it last until I got sales to support my expenses. And then you're going to have your operating costs. You have fixed costs and variable costs. I'm not sure if you guys are familiar with those terms. Fixed costs are kind of just a set thing. If I have a store, I have to pay rent every month, and it's going to be a set cost. That's a fixed cost. But if I'm selling, say I'm making something, I'm making a widget, well, it's going to cost me so much in materials and so much in labor per widget. And so variable costs are going to be driven by your sales volume. So it's going to change over time. So you're going to have a decent way of forecasting that and building that into your budget as well. And then bottom line is just going to be your profit, which is going to be your sales minus your cost. And while some of this sounds pretty familiar and kind of back to income statement type of stuff, it is kind of a different tool, and so don't get them confused that way. So beginning and trying to figure out your sales revenue, I guess the biggest thing I would stress is be realistic, especially when you're doing that initial feasibility and you're trying to figure out, is this thing going to budget? Is it going to work? Is it feasible? And that's where your research, your market research, is going to come into play. Are you going to be able to estimate quantity sold if you're selling a good? If you're doing a website or an app, where your revenue is going to come from? How do you really estimate, how much revenue that's going to bring in your first year, or when is it going to start kicking in? Your budget will kind of lay out month to month, and generally up front you're going to have no revenue. So what point do you think you're going to start generating that revenue? What point can you start budgeting it in, and is it realistic? Are you going to be able to collect that? Financing, especially with the B-launch ones, that's kind of an upfront thing. So you'll know you'll have X amount upfront to work with, and that'll hit your budget at the beginning, and then you'll be able to work with that going forward and make sure that the expenses you're planning are going to spread out and be able to be absorbed by that initial investment and start working for you until you can get some profits in place. And another point here at the bottom, minimize risk, and investors and banks want to know they're going to receive a return. And so that's what this budget also comes in to show. When you're presenting to an investor, is are you going to be able to give them a return, and how long are they going to have to wait for that return? They want to know about their risk. That's what they're looking for. Is this a really risky investment, or is this is this something that looks pretty safe? That's going to kind of determine A, how willing they are to invest, B, maybe what ownership percentage they're going to want in your company for it, things like that. So budget's an important tool. So operating costs, I think this is a tricky one for people who are just starting up their first business. There's a lot of different costs involved in a business, and until you really sit down and figure out what's your business model, how are you going to operate, it's hard to really say exactly what all those costs are going to be. So I've kind of listed some on here, and you'll find on your USB drives, I don't know if we mentioned this before, all the slides are on there. There's also an example spreadsheet of a budget that you can use. If that's helpful, it can take any form, though, if you want to do your own. I think Travis put a kind of a forecasting spreadsheet on there as well. So there's some tools on there that you can use, hopefully you find useful. But here's just some things to think about. Are you going to have development costs? We've seen a number of website or mobile app type things. You know, are you going to have development costs? Are you doing it yourself internally? Then you're not going to have a cost if you have a programmer on your team. But a lot of these have gone out and had to hire outside contract labor to do the actual programming and whatnot. So we got planned for that. Are you going to have a physical location? You're going to have utilities. You're going to have rent. You're going to have all that kind of overhead that you need to plan for and build into your budget. What's it going to cost? And all these things are going to take market research as well too. Figure out what kind of space you're going to have. Advertising. How are you going to reach the people? You can do internet advertising. We've seen quite a bit of that. How are you going to determine how much is that going to cost you every month? It's kind of hard to tell. You need to do some research on that as well and build in a realistic view into the budget. We kind of talked about variable costs already. If you're doing actual goods or something, or an actual product, you're going to have to build in some variable costs because it's going to change depending on your sales volume. And then on bottom line, taxes as well. If you're selling goods, you're going to have sales tax. Don't forget that. You're going to need to price accordingly because you're going to be collecting that 6%, and that's going to be due to the state as well. And then also income taxes if you're profitable that may need to be distributed to members to cover the profit tax on the profits of the company.
So I'll rush through forecasting, which is not much different than budgeting. I think budgeting, like Jordan kind of mentioned, is sometimes it's done annually. Most of the time it's done annually, and it's kind of your expectation where the business is going. With forecasting, it's more like, I've heard the analogy, budget is kind of what your expectation of where the business is going to be at a certain point, and then you measure yourself, kind of like the report card. Are you over or under budget at that point? What do I want to say? Forecasting is more of like a radar. It's where you're going on day to day. So you're kind of looking more of a short term and where the business is going. You kind of ignore the budget. The budget is kind of what you said at the beginning and what you expect or what you want revenues to be or what you expect revenues to be at the end of the year. Forecasting is taking a look more of, hey, if we go into this product line, what is it going to do to revenue? Is it going to increase revenue? Or is it going to make us lose revenue because now we're competing with one of our major customers, so they're going to stop buying product A because now we're offering product B? Or what if we start outsourcing this service or this piece? What's that going to do to our expenses? So you're kind of looking at it as you make decisions, you're forecasting what's happening to that. So a lot of things are fixed. So when you do forecast, if someone says, okay, this is what your financial statement is, snapshot a picture, what you've done over a period, this is what your budget is, what you've expected. But now when you're going to, say, an angel investor or any kind of investor or lender, you're saying, hey, I want money because what I want to do is make widget B, and I'm going to start selling it in Canada. So what they want to do in the forecast is you start looking at, okay, what will my income statement look like if I do that? What are your forecasts? What's that going to do to revenue? What's that going to do to expenses? So a lot of your fixed costs and overhead, they're not going to change. Your rent may not change. It may if you forecast that, hey, I'm going to have to expand twice the size of manufacturing space that I have now. So some of these may change, but for the most part, it's going to stay the same. Your variable costs are going to change, so you need to take those into consideration, what's happening to those variable costs as you go through your numbers. You can have more than one forecast. So as you're doing these forecasts, you can have a conservative one that's kind of a low price point, limited staff. What happens if in our budget we expect to grow this much, but say if we are limited in staff. A lot of people will do that, large corporations, as they move into a new area, or if they're competing for jobs, in this area, if you're competing for engineers and you have limited staff. So what's that forecast? If we're seeing lower quality of staff available or less quantity, what is that going to do to our financial numbers? You can go aggressive. You can do a forecast to say, hey, if our salespeople can get a premium price, if they can start selling this product for $50 instead of $30, this is what's going to happen. If we have this new sales pitch, and this is how they're going, and this is who they're going to talk to. We found new leads into the medical industry. Now they can go in there and they can start talking about our product and how it's going to help their operations and help save patients and everything. If we hit that forecast, if that's going to happen like we expect, then what is that going to do to our financial statements? Analytics, you're going to check key industry ratios. So whatever kind of business you're in, you'll want to look at some key ratios. Last year we brought the books, didn't we? So there are books out there that you can look up and say if it's a direct marketing business, you can kind of see what some key ratios are. If it's construction industry, they have key ratios. So what one industry's gross profit margin may not be another industry's gross profit margin. So there are a lot of factors where data has been collected over time and over industry and over companies. So you can kind of compare yourself to similar size companies and know what's the typical profit margin for a company with $100,000 or less in revenue. What else did I say here? Analyticals, depending on the type of business, you might get asked this. Kind of forgot my favorite little introduction is like, how many people watch Shark Tank in here? What do they always say on there? You need to know your numbers. I mean, they harp on it all the time. Kevin O'Leary is always like, you just need to know your numbers. Just the other day, they had a gentleman that was on the show, I think a year ago or a couple years ago, Echo Valley Meats, that he didn't get a deal because they were asking him question numbers of, how much does it cost for your customer acquisition? How much is this? And the guy was more of in the business type of guy. He knew how to butcher meat, how to get good quality meat, and how to get everything processed, but he didn't know the numbers. He wasn't a financial guy, so he couldn't answer a question, so none of them gave him a deal. Last week or the week before, he came in and they started asking questions like, how much does it cost, what's your customer acquisition cost? $26.62. I mean, he was saying those numbers, and then they were really impressed because then they can actually analyze, is this a business that's going to grow, that we can get some profit, maybe shed some expense, get bigger margins, and grow this business. So you have to know your business, and that's these revenues per whatever it is, depending on your business type. It may be revenue per employee is the most important thing. It may be revenue per salespeople. Someone may say, well, how much are you making off of every salesperson that you're getting out there? Because that's key to your business. It may be if manufacturing, it's like, okay, how much are you getting off for every machine hour that you have? And just common sense, review, re-review. It's, like I said, it's a radar. It's like a ship with a radar. You're always changing it. You're always seeing what's ahead of you. There's something might get into your way. You might have to shift and go around it. You're always going to have to watch your forecast. Your budget's kind of a solid set, what you expect, what you're measuring yourself out at the end of a period. Mentors, that's important. You're going to have that in this role. You're going to ask them, hey, if we're creating an app, ask them, Faisal, what's typical in this? What's the profit margins? When should we expect a profit? Should we expect a profit in year 2, 3, or is it more like year 5 or 6? Here's some, I think there are 3. Yeah, startup rules of thumbs. Everything takes longer to do than what you think it will. So if you think, hey, it's going to take us 6 months to do this, it's probably going to take you 12 months or 18 months. Everything costs more than you think it will. So always remember that when you're doing budgets and forecasts, especially, maybe I have it on a slide here, especially some of your overhead stuff. Legal, accounting, advertising. You might sit there and say, okay, if we're going to go into this new product or we're going to expand into this market, and it may cost us $5,000 more in advertising, might as well double that or triple that, because when you get there, you're going to realize, hey, no, if we're in here, we need to play big and we need to get our name out there. No entrepreneur thinks of everything. Here's some points of forecast, and like Jordan mentioned, all these slides are on the jump drive, so you can take a look at them. There's some tools and resources out there for you as well. I think that's all I have. I kind of mentioned some of these. Points of forecasting, make it easy to understand, document your assumptions and research, avoid some basic errors, math errors, whatever your industry is, make sure that you know your numbers. We mentioned the tools, spreadsheets, professional software. Startup companies, I would avoid professional software until you really start seeing growth. And of course, then you can always use accountants and consultants to come in and help you with this.